Hey everybody, John DeRelay, Head of Revenue Management Education here, and today we're going to talk a little bit about what's going on the Alabama coast. It's Q1, we're hitting the stride for high season, spring is coming up, summer, bookings are already starting, and we're going to dive into some Wheelhouse market data today and see what kind of trends we can make out so that we're best prepared to deal with the bookings and the booking window that are happening in 2025. So the first thing I want to bring up is the Wheelhouse market report. So this is just a super high level. We're looking at the Gulf Shores, Orange Beach, but also up into the Mobile and up into the Bay Area. I like to just look at this to get a few tidbits just to kind of qualify what we're going to be looking at. First of all, to note is these active listings that Wheelhouse has been tracking are up pretty substantially this year. So a lot of pressure on PMs because supply has been increasing. Now, I've heard from a number of other folks in a number of areas that there's news that this growth is leveling off. But even if the growth in new units levels off, we know that the actual impact of that is still going to be around for a long time. It takes a while to correct. People aren't necessarily going to leave the market immediately. And we've seen pretty substantial growth. Now, this is not something unusual. I've been looking at a lot of markets in Florida and across Texas and across the eastern coast, and a lot of markets have been seeing pretty substantial growth. That's probably going to impact us quite a bit going forward, and you can kind of see that already in the year-over-year occupancy just at a super high level. Now I'm looking at everything in the market. That's why this annual occupancy is pretty low, but pretty substantial drops here year over year. So good news is that drop isn't as much as the increase in inventory. So we're still seeing growth in travel, at least we did last year. But a lot of pressure from that growth, among other factors, kind of resulting in lower occupancy. Now, despite that, we've seen increases in ADR. We're seeing the inflation of the economy get built in. That is offsetting to a certain degree the occupancy drop. So we haven't quite seen it hit RevPAR. But my guess here is that whenever occupancy is dropping, what you probably have happen is some people are staying really booked at a higher rate and doing pretty well. A bunch of people are going vacant, which means they're doing way worse. So, think about how that bifurcation exists in your portfolio. It's really going to determine how you want to price those units this year. Just to kind of validate that, I've gone ahead and shown just the highest kind of, this is going to be between like 10 and 20%, depending on the market. And you can see when we're just looking at the top performing properties last year, their occupancy is much higher. They're seeing much less drop. So half of the drop in occupancy, they're maintaining even higher rate increase. And to a certain degree, that RevPAR is higher. So you can see that bifurcation where, when the market's under pressure like it is here with lots of new inventory, drop in overall occupancy, you actually have some properties that are probably doing much better. Their owners are getting a much different story, and you have a lot of properties that are probably going vacant and doing much worse. Let's just go ahead and contextualize this a little bit by jumping into a little bit deeper view. Right now, I'm still on the Wheelhouse market report, and I'm looking at trends page, adjusted occupancy, and we're just looking at the year over year and month over month occupancies. You can see, obviously, 2023 was a big peak. For the most part, that was the highest time period of the year for almost all months, except for Q1 over here. As we get into 2024, actually Q1 started out pretty good in terms of the snowbird season, but quickly once we hit March, that started to drop off pretty substantially, including in the summer. So a lot of pressure last year. Now, that did recover a bit in October. October seemed pretty good. I think there's a few things there. I think the demand was both strong. Also, I think that because spring and summer of 2024 were down, people started more conservative. It allowed them to build up a base of business. We know that as shoppers, shoppers right now carry exorbitant debt. There's less discretionary income than there has been in years. We also know that the kind of family demographic are millennials. So people don't think of millennials as the family demographic. They're the primary family demographic. They are also the lowest discretionary income bracket group of consumers in that bracket for a very long time. So a lot of squeezed pocketbooks. Now, what we have noticed is millennials still express a high desire to travel. So what's probably happening is millennials are shopping all the time. People who maybe couldn't spend the same amount or don't have the same amount of discretionary income are looking all the time because they're planning to travel and they're looking for those deals. So I think fall really started to perform well, and you see this in other markets as well, pretty strong fall performance. I think it's because In 2023, we started to see things drop off in the fall. People got conservative for 2024, and that allowed them to build this base of business. Now, I think we need to carry those lessons forward. If you're not already pricing conservatively for spring, especially during the dates that aren't going to be high demand, you're probably missing out on shoppers who are willing to come but aren't going to pay the top rates. Same thing for summer. Now, obviously, we don't want to give away our best stuff because the expectation of summer is going to be strong, but you probably had stuff that sold last minute or had some vacancy last year, and using those as an opportunity to kind of put things out there and just build a base of business, because you're not displacing the customers that are going to show up and buy. When we get into the high booking window, what you're doing is you're just capturing customers who are looking around, looking for a deal because they're only going to be able to afford, a little bit of travel this year. And the benefit here is you're not always taking those customers away from your own summer. What I've seen is there seems to be a lot of trading among markets right now. Those people who are looking for the deal, they're not just looking in Gulf Shores. They're not just looking in Orange Beach. They might not even just be looking in Panama City Beach. They may be looking all the way over in Destin, all the way onto the Texas coast, and they might have a lot more flexibility in where they go. And if you have pricing out there for them, not for all your product, but at least for some where you can give up a little bit, you might be able to capture those people, just put a little extra occupancy on the book and beat the market. Next thing I want to just glance at is the trends in lead time. And looking at the Gulf Shores, Orange Beach, Mobile area, pretty unusual trends. In a lot of places, we've been seeing shortening lead times. In some cases, we're seeing longer lead times. I think there's a few reasons for that. Let me just click off 2025. So if we go to the fall where lead times kind of increased, I think a lot of that has more to do with the fact that operators in the region were actually trying to get earlier lead times. They were positioning much more conservatively than they had in the past, and it allowed the shoppers who've always been there to actually buy in that time period where they wanted to shop. A lot of stability over the course of the summer, which I think makes sense. A lot of people were doing what they wanted to do. And then we've seen some pretty interesting changes around the snowbird season. And what I think is most interesting here is we've actually seen some increases here. So obviously there's not going to be a lot of last minute travel. People aren't looking to travel as much here. It's really about those snowbirds. This is a little bit of a red flag for me that this has gone up even more. It means that when economic conditions were maybe better and people had higher expectations, people were willing to book for these time periods, but that last minute window isn't coming in. We saw a little bit of that in March last year, where people expected there to be much more booking. The short-term window was really competitive, really a race to the bottom, and there just wasn't the volume. And I have some concerns if we continue to see that. We really want to be careful, especially for March, April, May. The goal here should be, in my opinion, if there's a risk that this short window is just going to have less travelers, that you're going to be competing, more people are going to be competing for less heads in beds, then you really need to work to try to get anyone who's looking now to book. And you got to look through your portfolio to find what listings you can actually put at rate points where they will buy. Because the fact that there were, normally you would expect these to drop pretty substantially as we get into the month because the month-end bookings come in. There wasn't enough to significantly drop this lead time. When we look into February, we should expect this to drop quite a bit if a bunch of bookings come in. But if not a lot of bookings come in the last minute, that's not going to drop. Little bit of a risk. And I think it's not a surprise that, when we look at last year, we saw these high lead times in this low season, but that extended into March. It wasn't until April that people got serious about kind of cutting those rates early. And I think that, it's a little early to tell. We won't really know, but might be the case already. We should see these be dropping, and the fact that these are pretty similar means that nobody is booking during a certain time period, and that's a problem, and we got to get on top of it, particularly because March is only a month away. April, if this lead time in April is 115 days, well, we're inside of 115 days. That means nobody is booking right now, and we got to get a handle on that. Next piece I just want to dive in with you guys is just kind of the occupancy levels again, but we're going to bring this all the way to the daily level. I think there's some really interesting trends, particularly in these Gulf markets around the spring, because obviously spring was really volatile last year. We expect it to be pretty volatile this year. And there's some interesting things we can see just in the current state of the occupancy. For one, we're building up our snowbirds. Those are starting to drop off. That makes sense. One question I have for folks is, we tend to see this drop off of snowbirds at the end of February. In the past, I think that early March had had generally been stronger, but I wonder if there's an opportunity here to maybe allow these snowbirds to start staying a little bit more into March, just to kind of bolster that low occupancy that happened last year. Looks like it's on track this year. Now, I know getting snowbirds to do anything is going to be really difficult, and it seems like there's a lot less snowbirds or new snowbirds coming around this season as things get more expensive. So, really curious to hear your guys' strategies and what your thoughts are about snowbirds, particularly as you're planning for the next year, 2026. I think the most interesting thing to note here, though, for spring, especially in March, is last year there were some pretty big peaks, but this early one really didn't reach the same level of occupancy that some of the other ones did. So definitely some weakness in the beginning. And then we have a few date ranges that are exceptionally low occupancy, right? When we look at this year, we're already seeing a little bit different of a trend materialize. This date range here, this end of March, is still looking really strong. It's obviously pacing the best, but we don't have this clear early mid-March spike. We actually have a few spikes here. The mid-March one is stronger, but there's a few bumps here. So it does show that there's a little bit more spread out looking to buy. I would also suggest that last year, this first week in April was really strong. Obviously, it was Easter, and this year Easter is not there, but big, huge mismatch. So if your rates are set up in a way that you're really basing it off of what you're doing last year, you really need to reevaluate this time period. And right now, this is a super low occupancy time period. You need to try to be competitive to drive as much rate as you can there, or to drive as much occupancy as you can there, because if you're holding high rates, you're probably going to set yourself up for a little weaker time period. Now, the other thing I think that's really interesting is when we go out to where Easter is, Easter's around these weekends, we're not yet seeing big bumps. They kind of all look similar. They look like April weekends. My guess here is that people are going to be booking a lot later for Easter because it is so much later. But keep in mind, too, it might be a pricing thing. People may not be willing to spend the same price as when these dates are stacked on top of a spring break week date. And you just may not have the pricing power. So really pay attention to your pacing here. Set some guidelines for yourself. We don't have a lot of data to know, like, well, this is how late Easters, operate. So set some guidelines for yourself. If we're 60 days out, if we're 90 days out, if we're 120 days out, where do you think you should be? You can use your pacing last year for Easter to get an idea of how far out, how booked you should be, and hold to that, because we're not going to know exactly what the pricing power is here because those dates aren't as stacked up. And you can already see, just even in March, the demand dates seem to be more spread out. It could be a good thing for occupancy, particularly if you're making sure that you're pacing and spending time selling. But it does mean that there may not be as much pricing power here. And if you get caught in the short window, it could be very, very competitive. Final little tidbit I want to bring up is the mid-May date range. May 17th seems to be pacing really well. That was another pretty high date. However, that doesn't look like an unusual date last year. It looked more like a date building up into the summer, and it looks like it's on pace really good. Maybe there's an event or a sports tournament or something going on. You tell me, but it's looking really, really strong right here. Might be some opportunities. If you're not getting a piece of that pie, maybe take a look at what your rate position is, maybe run some marketing stuff and see if you can also get a piece of what's going on here, because potentially this could be a really good bolstering of the month of May. The next thing I kind of want to talk about is just April in general. I see across gold markets a tendency to want to hold this rate a lot higher and then cut it down gradually as we enter the 90, 60, and 30-day window. Occupancy is so low across a lot of this time period, I really suggest that you consider flipping into the opposite strategy, a strategy I would call a base of business strategy, which is start at that average ADR position you're at. Maybe omit some of the properties that do consistently book at a really high rate and build it up, right? If you're pacing ahead, you can push the rate. But I really don't think that we want to be in a position where we're cutting the rates in the short term, because that supply issue that's in this market is potentially going to be a problem, especially if there's any volatility or uncertainty in how people are spending, and it could really cause prices to crash. So if those prices crash, you're going to be in a position that's actually worse than if you sell lower now and sell earlier. Now, the benefit of selling lower and earlier now is you can still position your rates above what you did last year. And if it was vacant, you have basically unlimited opportunity to do that. But if you see that you are pacing substantially above the market, substantially above your own historicals, you can actually start to push those dates up and push those time periods up to raise the ADR on what's remaining. And you can be really specific, because you can see here there's big differences between weekend and weekday pricing. And I think that Now, making sure you're not just taking April and dropping it or raising it the same is really important because there's a lot of opportunity here. Now, I think really early, like getting a really strong April and winning the occupancy game is going to be really key to covering this year if there is any instability. If things end up really good, that's fine. I think it'll still contribute if the year is good and you just beat everyone in April. But if the year is tough, you really want to be able to use these shoulder seasons to take market share from other people and bolster anywhere else that you might lose ground on ADR. And I think, right now is a great opportunity to really put those prices at the most competitive price you can offer. You're going to offer it anyway within 30 days. You might as well offer something similar now, at least on some of your units. Not only that, it's a great opportunity to put out different kinds of length of stay stuff. Maybe that is discounts or promotions through your direct marketing where you can really try to get people who are looking, they're like, I want to travel for spring break. I can't afford to go during the peak time. They might come and stay with you for a week. The other thing too is you could just slam down those weekday prices. If you don't have all the tools for the promotions, keep them lower, keep your weekends high. That way you don't lose out on the weekends, which are primarily where the occupancy is coming anyway, but you're just giving yourself an opportunity to book more. And especially if you just do it on the rack rate, you're giving people an opportunity to book 4 nights or 5 nights, which could be really, really beneficial in terms of capturing market share for occupancy. So the next thing I'm going to dive into is I'm using our dynamic sets tool. So I have built 3 different sets, one for all listings in Gulf Shores, one for 2 bedrooms in Gulf Shores, and one for 3 and 4 bedrooms in Gulf Shores and Orange Beach. I used our dynamic sets and kind of customized this a bit. I really just looked at properties that were open most of last year and had pretty good occupancy, so we can kind of see what those people are doing. And we're just going to glance at this. In reality, a lot of this is probably going to be similar to what we were seeing at the top level, but there might be some interesting tidbits here that we can take a look at. And the first one I want to take a look at is just this booking pace chart. So really, we're just counting up how the unavailability is coming in, and we do have a little bit of a highlight in terms of the last 2 weeks. And these trends, they look pretty similar, but there are some minor differences between them. Obviously, we have pretty weak on the books through the snowbird season. But once we get into March, you start to see that pattern emerge that I talked about at the high level, which is there's not a super clear leader in the March dates. You actually have these 3 little bumps that are all consistently booking at a decent amount, pretty similar amounts. Now, that March 24th time period is the one that is looking the highest, but you are seeing these little bits of demand on the 19th, 18th, 19th area, and then in the middle of the week, the 11th and 12th. And so I think really paying attention to this is important because it looks different than how last year ended. Last year, you had this one big spike and then another spike at the end of the month, then a spike at the beginning of April. Right now, it looks like we have 3 kind of mild spikes through the middle of March. And so really going in and even just reviewing your position, reviewing your pacing, and making sure that you're taking advantage of this and driving as much as you can is really important. We still see that lull here in the beginning of April, so it's super important that that's captured. And then kind of looking out, we just see gradual booking across the board, a little bit more in May across this set. And I think the key here is really just paying attention to those differences in March. If we jump over to the 2 bedrooms, we see pretty similar thing, except that end of March is much more exacerbated as being bigger. That's pretty interesting to me. There's just, when we just look at the 2 bedrooms, people are really going for that time period. I'm not sure what that says about the customer. We do still see bookings in the other times. And otherwise, things look pretty similar, but there is a little bit of a shift. Those smaller units are definitely favoring the highest occupied date. When we look at the 3 and 4 bedrooms, we see that even split again. But what's really interesting is that the pacing in the beginning is actually a little bit higher. The last one is still the highest, but in terms of actual pace, if I turn this off here, you can see that this early part is pacing a little stronger. So I think the story here is that March looks different than it did last year. There's a lot of inconsistency in booking trends, and this could be driven by a number of things. It could be driven by the properties. It could also be driven by the pricing that we have. I'm not sure what you guys are doing here yet, but if that early March is a little bit weaker in price because it didn't perform last year, maybe that's where people are going. They're actually driving to where the deals are. So you got to think like, hey, can you offer deals at certain time periods and in certain parts of your portfolio to try to move the flow of bookings so that you can kind of evenly distribute them across the whole portfolio over the course of the booking season? I think what I'm saying kind of bears out a little bit when we look at the actual pricing aggregates for these groups. Even though the 24th kind of area is the highest occupied, it is also highest price. Maybe the market's already building that in. It was really strong last year, so we knew initially. So we're getting early booking there because it's one of the most popular time periods to book. The prices reflect that. But what's interesting in these 4 bedrooms, of which the booking window is getting short for the beginning of March, they're already the lowest priced area. And that's starting to be the place that is actually picking up the most. So I think, especially for these big ones where we're running out of time, we really need to be cognizant that the customer is pretty sensitive, that they are responding to these differences in price. And you need to be really aware of what's going on in your portfolio so you can take advantage of it. I don't think it's any accident that when we look and see the largest units that need to book earliest, that the actual highest pacing in the set is where the lowest price is in the shortest time period. But I do think that we should be kind of bolstered by the fact that we are still seeing this trend of all 3 of these date ranges picking up, including the date range with the highest price. Now, another thing I would like to point out here is the April prices seem really high. Obviously, we want to keep things high for Easter, but in these areas where occupancy remains pretty low, this pricing is still pretty high. I mean, we're basically looking at second week of March, and I guarantee you're not expecting the same kind of revenue as in the first, second, or third weeks of March. So going ahead and the people in the market who go ahead and get ahead of this and start adjusting April where they expect the low demand dates to be really competitive are the ones who are going to do the best in the market and take the most market share, hands down. I really want to just drill that point home. So I've gone into my set for, the all bedroom count Gulf Shores Orange Beach. And when we look at last year's April compared to this year, what we can see is that, these occupancies are all right, but they're well below the peaks that we get in March, right? And the weekdays are way, way below any time period in March, really. It's the lowest time period pretty much the whole year. So there's really a lot of difference here between March and April. And when we go back and look at the rate position at the market level, we're not seeing that much differentiation in the rates across April compared to March. And I think that's a huge missed opportunity, especially for those larger properties, but really any group of properties, is that you're going to cut this rate anyway. You're going to have vacancy. Go ahead and take that stuff down to where it actualizes, and you may be surprised by the pricing power that you have. You may be surprised by what you can drive in occupancy. I think this is a lesson tons of markets around the Gulf, including our friends in Alabama, have learned, especially in the fall. They started super conservative. We've had pretty good falls despite, the overall market conditions not being that good for almost 2 years now. And for whatever reason, I see a lot of resistance in Florida, in Alabama, in Texas to operating this way in April. And I'm not totally sure why. I do understand that you can't do that too far in advance because we don't always know what dates are going to be the best dates for spring break, how Easter is going to come in. But we do know that there are some dates that are going to be weaker, that really have nothing that's clearly going to drive them. And when we look at this, those rate positions shouldn't be equivalent to the mid-level March rate positions when we look at the occupancy, and the occupancies are substantially lower. Like, why would we price something as it, like, the price is a measure of what we expect its demand to be. We know this demand isn't going to be the same. You guys need to, if you react now, I think it's a huge opportunity for those that do. One final piece to kind of drill that home and hammer that home is when we look at the average ADRs for this time period, that is reflected in what actualizes. You can see that April is way down here, whereas March is way over here. So April. And this year, we just don't have that. So the thing is, you're going to do it. Why not take advantage of it now and get anyone who is shopping or looking for a deal or is flexible in their stay? They're not going to displace a customer during the highest time period. Someone else, you'll be able to price for someone else in those times. It's just going to be additional occupancy and additional money in your pocket. Well, thanks for spending some time with me. I really hope this data was helpful. We're going to be doing this more often, so keep an eye out. If you guys have any questions, feel free to let me know. I can start investigating information like that. If you'd like an update, let the Wheelhouse team know, and we'll plan another time to kind of dive in, particularly as we get into summer. And if you want to dive into some of this data yourself or with a Wheelhouse revenue manager or team member, contact our sales team, and we're happy to walk you through the data and show you how you can access all this data yourself, because everything I went through is available to our Wheelhouse partners. Thanks and have a great day.